Dan, interesting move from Buffett buying HP. Doesn't sound like what you would do.
No, I like companies that are in growing industries, that there's more value to it 10 years from now than today. I think you touched on it well in your preamble. You know, they've tried to get into things like software. It hasn't worked out very well. I think this company's a lot more like IBM. I mean, you can switch from an HP computer to a Dell computer. You can switch from their printer to a Canon printer. There's just no lock-in, at least with an Apple. You know, if you are on their ecosystem and you bought things off of iTunes or movies, et cetera, there's some sort of lock-in there. There's none with HP. So it's great for a buyback. It's great for the dividend. You know, utility stocks are the second best performing sector in the market this year. They're up 6%, which is unusual when you think about it, because usually utilities move inversely to whatever interest rates are doing. So if the 10-year treasury is going up a lot, like it has this year, you normally expect utilities stocks to go down. That's not what's happened this year so far. So I think, you know, HP is going to sort of go down, unfortunately, the same path as more IBM versus an Apple in that regard.
Yeah, interesting how Dell, which was once a peer of HP's, more significantly made some aggressive moves into software, into storage, and is configured differently today as a result. But let's get caught up on how you're looking at this market, especially your "don't fight the Fed" mantra, which means something different with interest rates on the rise. What have you learned over the past couple of weeks since we last had you on about how the market's reacting to the anticipated interest rate moves?
Well, I think the biggest thing you've learned is you look at what Lael Brainerd had to say, who's considered a dovish member of the Fed. And I saw that statement where she said that not having a job or inflation is just as bad as not having a job. And that's from a dovish member of the Fed. So that tells you that the Fed, for whatever reason, whether it's Powell getting renominated in November or the data since then, has decided, okay, we really have to go deal with inflation, and we're going to have to get very aggressive to deal with it. And, you know, people love to use "don't fight the Fed" for justifying, you know, why to buy stocks and why the stock market should go up. But, you know, remember, the Fed added $4.8 trillion of stimulus since the start of the pandemic. The government gave us $5.5 trillion in stimulus since the start of the pandemic. So that's over $10 trillion. The U.S. economy is only $20.5 trillion in size. So that's why the stock market's gone up over the last 2 years. You didn't want to fight the Fed. You had the market go up with a global pandemic the last 2 years. So the same thing applies on the way back down. And you've seen that as rates have continued to go higher and the markets continue to struggle, particularly technology stocks, which are the worst sector within the S&P 500, you know, throwing comm services in there, obviously, as well, that has internet in it.
Hey, Dan, it's Deirdre. You say don't fight the Fed, but the Nasdaq still down 15% from its 52-week high. How do we know how much of this is baked in? I know you think the recent rally was a bear market rally. How much further could we go in the downside?
No, I think there's a lot more downside. I mean, I said when we came into this year, I thought the market would be down at least 20%. And, you know, what I would say is that the at least is definitely the case, because I look at this and I say, well, I've got Europe, which obviously business there is starting to slow down. You've seen Adobe come out, Restoration Hardware, UiPath. Those companies all had February quarter ends. Remember, Russia invaded on February 24th. So that's only 4 days left in their quarters. They all reported, they all said, you know, Europe's slowing down, et cetera. Those stocks are down between, I think, 35 to 75% this year. They went down about 9% to 26% the day they reported, after they had already been down a lot. So that shouldn't make you feel particularly good if you're going into earnings season, when between currency, the dollar being really strong, between what's going on in Europe, between China being in lockdown again and being the biggest end market in the world for things like autos or PCs or smartphones, you know, all of that should make you very concerned, given where valuations are sitting and given the Fed is now looking at inflation as a big problem, even akin to not having a job. That should make you very nervous.